I've been sitting with this data since Tuesday night, and I need to be honest with you about where I've landed. I have gone through every possible benign reading of what occurred on February 25th, 2026. Infrastructure failure, software regression, routine latency spike, and not one of them survives contact with the timeline. The moment you map the specific calendar context onto what the exchange did and when it did it, the word accidental stops being available. What replaces it is a word that carries serious weight: deliberate. Or if you want to be more careful about the standard of proof required, let's call it functionally deliberate, meaning whether or not intent can be established, the functional consequence is identical to what a deliberate actor would have engineered. I want you to hold these numbers in your head right now. This is Thursday, February 26th. Silver opened at $86.28. Gold is priced at $5,165.90. The gold to silver ratio sits at approximately 59.91, a multi-year compression low, and the most structurally consequential single deadline in the modern history of COMEX silver futures is less than 24 hours away as I record this. If you are reading mainstream financial coverage right now, you will find this story either buried beneath earnings reports or missing entirely. That disappearance from the financial press is not editorial oversight, it is a pattern. And documented patterns assembled with sufficient precision stop being circumstantial. I'm going to show you exactly what I assembled. Let me start with what is publicly confirmed. Every detail I'm about to give you was reported by Bloomberg, Reuters, and multiple major commodities news platforms. On February 25, 2026, at 12:11 p.m. Central Time, CME Group's Globex platform began registering system errors. 4 minutes after that, at 12:15 p.m. Central, CME Group declared a complete trading halt across metals and natural gas futures and options. Natural gas was restored within approximately 35 minutes. Metals, gold, silver, copper went completely dark. No price discovery, no hedging capability, no order execution whatsoever. For a full 90 minutes, the single largest derivatives exchange on Earth ceased to function for the precise market currently experiencing the most severe acute physical delivery pressure in its recorded operating history. When the platform finally came back online, silver had given back a meaningful portion of its advance toward the psychologically and technically critical $90 level. More significantly, every standing order that had been live before the halt, every all-day order, every good-till-date order built around key price trigger levels, had been completely purged from the system, reset, gone, vanished as if they had never existed. CME Group's formal public explanation for why this happened 2 days before the most critical delivery deadline on the silver calendar: 2 words, technical issues. No technical postmortem, no independent audit, no third-party review, no press release with infrastructure specifics. 2 words, delivered with the institutional confidence that the market would absorb it and move on. If that were the complete record, you might, reluctantly, accept 2 words and continue. But that is not the complete record, not even close. Here is the detail that stopped my analysis cold when I was building this timeline. Tuesday was not the first occasion. It was not even in the neighborhood of a first occurrence, and the timing is not a coincidence that holds up under honest examination. On November 27th and 28th of 2025, less than 3 months ago, CME Group suffered a catastrophic 10-hour shutdown. Not 90 minutes, 10 hours. The initial explanation given to market participants was a cooling system failure at the exchange's primary data center in Aurora, Illinois. That explanation was subsequently and quietly revised to human error. The revision received no headlines, no congressional inquiry followed, no regulatory penalty was announced. A silent amendment in a footnote issued after the market damage had already been absorbed. Now here is the specific detail that transforms coincidence into documented pattern. That 10-hour outage fell with precise calendar alignment on first notice day for the December 2025 silver contract, the exact structural date on which long holders of silver futures can formally initiate physical delivery demands. Tuesday's 90-minute halt occurred exactly 2 trading days before first notice day for the March 2026 contract. 2 separate outages, 2 separate contract months, both arriving within the narrow 48 to 72-hour window immediately preceding the most consequential structural deadline in each contract's life cycle. And in both instances, silver was in the middle of a sustained directional advance toward price levels that would have triggered significant forced short covering had the advance been allowed to continue without interruption. There is a historical precedent for what exchanges do when a commodity's short position becomes untenable under physical delivery pressure, and it is not a precedent that reflects well on the institutions involved. In March 2022, the London Metal Exchange halted nickel trading after prices doubled in a matter of hours, as a concentrated short position, reportedly one of the largest in that market's history, began to collapse under delivery pressure. The LME's response was not just to halt trading. The exchange retroactively canceled every nickel trade executed on March 8th, erasing $3.9 billion in already completed transactions to protect the short side from the consequences of the position it had built. The nickel market's credibility has not fully recovered. Market participants now understand that when exchange-level short exposure becomes large enough, the exchange itself becomes a participant in the resolution. Keep that precedent in your mind as we go through what follows. Nikki Shields of MKS PAMP, one of the most credentialed institutional voices in the global precious metals space, told Bloomberg directly that Tuesday's halt obliterates the confidence institutions require in liquidity and price discovery, specifically at the moment when the market is already navigating extreme structural dysfunction. That assessment did not originate from an anonymous forum post. It came from an institutional precious metals authority, who publicly questioned CME's operational integrity during an active delivery window. Josh Philip Farr, CEO of Scottsdale Mint, a functioning commercial mint with real vault inventory and real customer obligations, noted publicly during the halt that the previous time COMEX metals went dark, silver subsequently moved substantially higher over the following months. He was not speculating about mechanism. He was doing what experienced commercial operators do, documenting a pattern based on direct professional market observation. Ask yourself this with genuine intellectual honesty. What is the statistical probability that the most technically sophisticated derivatives exchange in the world suffers 2 catastrophic system failures in under 90 days, and both of those failures land within 48 hours of first notice day in consecutive silver contract months, while silver is approaching price levels in both instances that would have forced large-scale short covering? Once is infrastructure risk. Twice at the same structural calendar point is a pattern that 2 words categorically cannot explain. I want you to think carefully about the asymmetry of consequences from that 90-minute blackout, because this outage did not land on every market participant equally. Its consequences fell with precision on specific positions. Consider who benefits from 90 minutes of complete pricing darkness 2 days before first notice day. It is not the long holder who is already committed to standing for physical delivery. Those participants had made their decision before the halt. The halt changes nothing for their intent. The participants who benefit from 90 minutes of zero price discovery are the large commercial short holders who have been watching COMEX registered vault inventory collapse toward a documented all-time low, who have been watching delivery demand accelerate to volumes that have no precedent in the modern history of this exchange, who needed pricing silence to manage their exposure, to restructure, reposition, negotiate, without the market watching precisely what moves they were executing. The halt erased all-day and good-till-date orders that were almost certainly clustered around the $90 level as the trigger point for the next acceleration in buy-side pressure. Those orders did not evaporate into neutral space. They were eliminated in a manner that removed the specific market pressure most damaging to whoever was positioned short at that price threshold. Whether Tuesday's outage was architecturally engineered to produce that outcome, or whether it happened to materialize at a moment that served the same structural function through operational coincidence, is a question I cannot answer definitively from available data. What I can state with precision is that the functional consequence of that 90-minute window, given where delivery data stood, where vault inventory stood, and how many hours remained before the most consequential deadline in the March contract's life, is operationally indistinguishable from intentional delay. When a documented pattern produces the same functional outcome twice in sequence at the same structural calendar point, the burden of proof does not rest with those observing the pattern. It shifts to those claiming the pattern is coincidental. This channel exists because the mainstream financial press consistently fails to connect this specific class of dots in real time. By the time coverage appears, the window has already closed. Subscribe right now. Turn on notifications. Because what I'm about to walk you through, the vault drain, the delivery acceleration, the Shanghai pricing divergence, the bank repositioning data, and the regulatory architecture that explains why that repositioning happened, represents the most concentrated cluster of documented physical market stress signals since 2008. If this is giving you information you did not have an hour ago, press the like button. The algorithm requires your engagement to place this in front of the people who need it before tomorrow morning. Now I want to give you the context that makes the pattern visible in its full dimensions, because this analysis is not theoretical, it is not speculative, it is grounded in exchange data, CFTC filings, and the documented statements of institutional participants who operate directly inside this market. Begin with January 30th. Silver reached $121 per ounce on January 29th, an all-time nominal high. The following session produced what the data confirms was the worst single-day percentage decline in silver since 1980. Silver collapsed from $121 to approximately $76 to $78 in a single session, a 33 to 36% crash. The documented and officially acknowledged catalysts were the nomination of a hawkish Federal Reserve chair and CME margin rate hikes from 11% to 15%, implemented during the trading session itself, not announced ahead of market open, not phased in over multiple days, executed intraday at the precise moment of maximum retail long exposure. Here's the data point that demands your undivided attention. Reports, unconfirmed by official regulatory filing but consistent across multiple institutional sources, circulated that JP Morgan closed approximately $10 billion in silver short positions at the precise intraday bottom of that session. If that reporting is accurate, then what the market experienced on January 30th was not a natural correction. It was a coordinated liquidation, engineered to produce the lowest possible exit price for a massive institutional short position, executed during the window when retail panic was most acute and bid-side support was most depleted. Now observe what JP Morgan and other large commercial banks did in the immediate aftermath of that event. Craig Hemke's analysis of CFTC commitment of traders' data reveals that U.S. commercial banks have repositioned net long silver for the first time in recently documented memory. The institutions most historically associated with the commercial silver short trade have fully reversed their directional bias. But here's the dimension this repositioning story has been missing in most coverage of it. There is a structural regulatory driver that explains not just why these banks moved, but why they had to. And that driver is Basel III. Under the net stable funding ratio framework established by the Basel Committee on Banking Supervision, banks are now required to hold stable funding equal to 85% of the value of their unallocated silver positions. Holding a large naked paper silver short, the kind of position that characterized commercial bank silver exposure for the prior 2 decades, now carries a significant and permanent balance sheet funding cost that it did not carry before the NSFR implementation. The regulatory arithmetic transformed the short silver trade from a free carry position into a capital-intensive liability. Going net long physical silver, or eliminating the paper short exposure entirely, is not just a market directional call at this point. It is the path of least regulatory resistance under current Basel III requirements. These banks did not reverse their position purely because their internal models told them silver was undervalued. They reversed their position in part because the regulatory cost of maintaining it became prohibitive. That interpretation is either a calculated capitulation driven by internal assessment that the physical shortage cannot be sustained at current paper prices, or an anticipation of forced covering as registered vault inventory approaches the delivery arithmetic breaking point. Neither interpretation produces a bearish directional conclusion for physical silver. The Shanghai Futures Exchange, meanwhile, suspended 25 trading accounts in February for alleged manipulation, actively deploying enforcement authority inside a market operating under structural stress. COMEX, operating under comparable delivery pressure, took no equivalent enforcement action during the same period. One exchange suspended accounts, the other suspended trading for 90 minutes and issued 2 words. Now let me give you the specific documented numbers that explain why this week carries the structural weight it does. These are not projections. These are exchange records, CFTC filings, and warehouse data. As of February 20th, 2026, COMEX registered silver, the metal formally designated as deliverable against futures contracts, sitting in approved warehouses, fully assayed and serialized, stood at 88,191,591 ounces, a documented all-time low in the recorded history of that inventory classification. By February 24th, that figure had declined further to approximately 87.2 million ounces. Vault stress condition confirmed. Paper to physical ratio documented at 73.1 for total open interest against registered inventory. Hold that figure against the baseline. In 2020, COMEX registered silver stood at approximately 346 million ounces, from 346 million to 87 million in 6 years, a 75% collapse in the physical backing of the world's primary silver futures market. And critically, the pace of that drain has been accelerating, not decelerating. From October 2025 through this week, total COMEX silver inventory, registered plus eligible combined, has fallen 31%, compressing from approximately 532 million ounces to roughly 366 million ounces. The daily drainage rate running through early February was tracking at approximately 785,000 ounces per trading day. Every single session, another 750,000 ounces leaving the system. Andy Scheckman of Miles Franklin, who monitors COMEX delivery reports on a daily operational basis, has described what he characterizes as deep-pocketed, likely sovereign participants, executing systematic and coordinated physical removal from exchange vaults at volumes he has not observed during his career in the physical metals business. Now set that drain rate against the demand structure. March 2026, open interest, the outstanding futures contracts representing notional claims on physical silver, sits between 240 million and 500 million plus ounces depending on measurement timing, against 87 million registered ounces. That is a paper-to-physical ratio of between 3.1 and nearly 6.1. And as of tomorrow morning, first notice day, long holders of those March contracts can formally step forward and demand physical delivery. The delivery data heading into this deadline is unlike anything in this market's modern documented history. December 2025 recorded 46.6 million ounces actually delivered, 50% of total registered inventory transferred in a single contract month. January 2026 recorded 49.4 million ounces delivered, a 727-fold increase over January 2024, 727 times. That is not a statistical rounding error. That is a categorical transformation in the behavior of institutional participants toward the delivery mechanism of this exchange. February 2026 through February 24th shows approximately 24.8 million ounces demanded, at a delivery acceptance rate of 98%. In a normally functioning, well-supplied futures market, the delivery rate is a small, single-digit fraction of open interest. The market's participants want price exposure, not physical metal. A 98% delivery rate is the signature of a deliberate, coordinated institutional decision to remove physical silver from the exchange system, regardless of cash alternatives offered to them. On February 24th, the day before Tuesday's halt, 229 new delivery notices were issued in a single session. Wells Fargo issued 228 of those 229. BNP Paribas stopped 155 contracts on the receiving side. Over 1 million ounces of physical silver demanded for delivery in a single trading day, 3 days before first notice day. On that same session, March open interest dropped by 14 to 196 contracts. Of those, only 5,350 rolled forward to the next contract month. The remaining 8,846 contracts, representing approximately 44 million ounces of notional silver, simply closed. They did not roll. They did not stand for delivery. They ceased to exist. The most structurally coherent explanation for 44 million ounces of paper silver evaporating on the same day that Wells Fargo issued 228 physical delivery notices is that the holders of those departing contracts accepted cash premiums to exit without demanding metal. Someone paid them to walk away. If that reading is correct, the question is not whether the system is under terminal pressure. The question is how many successive rounds of premium payments remain financially executable before the cost of clearing remaining delivery demand exceeds the resources available to the short side. A large portion of the people watching this video remember 2021, the Wall Street bets silver push, social media organizing retail buying pressure, headlines about squeezing institutional shorts. The price moved and then it stopped, and retail participants absorbed the losses while institutional positions survived intact. The assumption many carry forward from that episode is that 2026 is a repeat of the same movie. It is the most dangerous analytical error a silver market participant can make right now. The 2021 move was almost entirely paper in its construction. Exchange-traded fund inflows, leveraged futures momentum, social media-coordinated retail energy applied to a paper instrument. There was no material institutional physical delivery pressure behind it. Registered vault inventory was not in collapse. Delivery demand was not running at 727 times prior year volume. The Shanghai premium above COMEX was not running at $10 to $12 per ounce. London lease rates were not approaching 40%. Major financial institutions were not issuing 228 physical delivery notices in a single trading session. The 2021 move was retail energy encountering institutional resistance at the paper level. When the paper instrument pushed back with margin escalations and broker restrictions, the retail energy dissipated. There was no physical foundation beneath it. What is operating in 2026 is institutional, physical, and directionally self-reinforcing. Wells Fargo issued 228 delivery notices in a single day. BNP Paribas stopped 155. These are not coordinated Reddit accounts. These are major regulated financial institutions demanding physical metal from a vault running at a documented all-time low. Jane Street, one of the most quantitatively disciplined trading operations on Earth, a firm whose positions are driven by models rather than sentiment, became the largest holder of SLV in Q4 2025 after increasing its position by 20,672,537 shares. Jane Street does not hold convictions. Jane Street holds models. Their models say own silver. And China, which has designated silver a strategic national resource, is not participating in COMEX paper pricing mechanisms. China is paying whatever the physical market requires and absorbing the metal permanently into its national industrial supply chain. These participants cannot be margin called. You cannot wait out Wells Fargo's delivery standing. You cannot issue a stop-out notice to a nation-state's strategic resource acquisition program. The playbook that neutralized 2021 does not apply to 2026. In 2021, the pressure vector was from below, retail pushing up against institutional resistance. In 2026, the pressure is simultaneous from above and below. Institutions demanding physical delivery from one direction, nation-states restricting supply flows from another, industrial demand from solar panel manufacturing, electric vehicles, and AI-driven semiconductor fabrication providing a structural permanent floor beneath the price. The 2021 playbook required retail capitulation to succeed. The participants driving the 2026 delivery surge are not going to capitulate. They are taking the metal. Let me give you the clearest evidence that the paper price and physical reality are now operating as two fully decoupled markets. Because when two markets assign different prices to the same commodity, one of them is providing accurate price discovery and one of them is providing price management. Shanghai silver as of this week trades at approximately $100 per ounce. COMEX silver as of this Thursday morning sits at $86.28. That is a $10 to $12 per ounce premium, 12 to 16%, for the same physical metal in a different geography. In the immediate aftermath of the January 30th crash, that premium briefly reached $20.98 per ounce, or 29% above the COMEX paper price, in a single moment. Wholesale physical premiums inside China hit 45.8%. When the same physical commodity commands a near 46% premium in a major consuming nation over the price quoted on the world's primary futures exchange, those two venues are not discovering the same price. One is discovering the price of paper claims on silver. The other is discovering the price of actual silver. And here's the additional dimension the paper-physical divergence story has been largely missing. The gold-to-silver ratio right now stands at approximately 59.1. 1 ounce of gold purchases approximately 59 ounces of silver at current prices. The historical mean for that ratio is between 47.1 and 55.1. During the 2011 silver rally, the ratio compressed from 68.1 all the way down to 32.1. Silver outpaced gold's own significant advance by more than 2.1 during the compression phase. With gold currently priced at $5,165, a reversion to the historical mean ratio would arithmetically imply silver prices well above $100 per ounce. A compression to 2011 levels would place silver arithmetically above $160. That arithmetic does not depend on any manipulation narrative, any COMEX mechanics argument, or any conspiracy framework. It depends only on the mean reversion properties of a ratio that has reverted to the mean in every prior cycle without a single exception. The structural reason the Shanghai COMEX gap is not a temporary arbitrage anomaly is China's designation of silver as a strategic resource effective January 1, 2026, with export license restrictions now applying to approximately 70% of global refined silver supply flows. China is not interested in supporting Western paper pricing infrastructure. It is acquiring physical silver at whatever premium the market requires and internalizing it into its strategic industrial chain permanently. Solar panel silver paste alone accounts for approximately 30% of silver's total industrial consumption. AI-driven semiconductor demand is creating additional permanent industrial demand floors beneath that figure. London silver lease rates, the annualized cost of borrowing physical silver from LBMA vaults, have spiked to 34.9%, with intraday peaks touching 39%. Nearly 40 cents on the dollar per year simply to gain temporary access to borrowed physical silver. Lease rates at those levels do not describe a market with adequate physical supply at current price levels. They describe a physical market under severe institutional stress that is being papered over by a futures-derived price that does not reflect the real-world cost of obtaining actual metal. Let me tell you what the next 72 hours structurally require, based on documented arithmetic rather than speculative prediction. Tomorrow, February 27th, is first notice day for the March 2026 silver contract. Every long holder of a March futures contract can formally notify the exchange of physical delivery intent. The delivery acceptance rate running into this deadline is 98%. If that rate holds, even partially, if a significant fraction of remaining open interest stands for delivery rather than rolling or cash settling, the arithmetic at current registered inventory levels does not close. The mathematics is insufficient. 87 million registered ounces against a notional claim structure representing multiples of that figure. The system has documented structural responses available, but none of them are frictionless. First, eligible to registered conversion, approximately 278 million ounces of eligible silver sits in COMEX warehouses. That is a material buffer in isolation. But eligible holders watching Shanghai pay $10 to $12 above COMEX, watching LBMA lease rates approach 40%, watching every major physical pricing venue globally price metal above the futures-derived price. Those holders are not obvious sellers into a suppressed paper market at current price levels. Conversion requires willing sellers, and willing sellers require a price incentive. Every physical signal available is currently telling eligible holders that current prices are not accurate. Second, cash premiums to dissuade delivery standing. We already documented the likely deployment of this mechanism on February 24th, when 44 million ounces of open interest closed, consistent with holders accepting cash exit premiums to abandon delivery positions, but each successive round of premium payments becomes more expensive and more visible. The cost curve for containing the delivery surge is rising faster than the resources available to contain it. Third, emergency exchange authority. COMEX possesses the legal power to modify contract terms, impose emergency position limits, or compel cash settlement. The precedent for this exists, but deploying it would simultaneously resolve the immediate delivery mechanics and permanently answer the question of whether COMEX is a genuine price discovery mechanism for physical commodities, or a price management mechanism that processes paper claims. That answer would be globally consequential for how institutional capital positions itself in physical versus paper precious metals from that moment forward. And fourth, a mechanism the original coverage of this situation has consistently omitted, CME Rule 589. This is the exchange's explicit contractual authority to mandate cash settlement in lieu of physical delivery, if, in CME's administrative determination, physical delivery has become impractical or disruptive to orderly markets. This is not a theoretical construct, it is printed language in the CME rulebook. Its invocation would not merely be a technical resolution of a delivery crunch. It would constitute a public declaration, by the exchange itself, that its physical delivery guarantee is conditional, subject to administrative override when the physical backing is insufficient. The market implications of that declaration would extend well beyond silver.